Hello and welcome to the stock specific class here for Thursday, March the 18th. Quick look at the market conditions. We had the Fed meeting yesterday, and the Fed is really on board with letting inflation increase. We'll see if it's a good decision. The market is right now is a little uncertain. At least the way it's trading today is it's a little uncertain as to whether or not it's a good idea or not. But yesterday, when we had that kind of bullish reversal day, and we started to see money flow back into the riskier stocks, it really looked like it was risk on again, and I finally was able to see a lot of charts that looked like they had strong potential going up, and it made me feel like it's possible that the NASDAQ 100 could rebound and possibly even reach a new all-time high along with the other indexes that have already done that. But today reversed that, and it's got me a little bit nervous. Luckily, the volume is pretty light. We'll look at the charts here in just a second. The volume is fairly light today, so hopefully it's just a little bit of a day where traders are just trying to figure out what all this means for the long term. And because if we slide back down off of that reversal we had yesterday, it's really going to make things unpredictable right now. Usually, when I usually look at charts and look at the market, it's usually pretty easy to identify the trend direction and identify the price action. But every now and then you get into these periods of uncertainty, and it's hard to tell if the trend is looking like it's going to continue or if it's going to reverse. And it makes sense, so when you think about it, because all we're doing is trend traders is trying to read what everyone else is doing, what the big professionals are doing. And if the big professionals are uncertain and they're not real confident either way to buy or to sell, then you kind of start moving a little bit sideways or whipsaw back and forth, and then it makes us as trend traders not quite sure what direction the market is moving in or likely to move in. And so you just have to accept that there are periods in the market where you just can't really read it clearly, and that's okay. And usually that's a sign, though, that you don't want to be getting into too many aggressive positions, and you kind of want to move to the sidelines a little bit until things can clear up a little bit. And so, and that's the toughest thing to do. Sometimes the toughest thing to do is to not trade. You got this money in your account, you want to do something with it. But if the conditions aren't real clear, sometimes the best thing to do is just kind of sit tight. In my earlier trading days, that was usually when I can anticipate that things were becoming a little bit more uncertain. It's harder to read the trend direction. I would plan a quick vacation or something to get away from the market for a week or so, because you always need that time to refresh your battery. And then, that's the perfect time to do it is when you're not, I don't want to be on vacation during a strong trend when I'm going to be really tempted to watch the market all day long. So anyway, so as far as the direction alerts are concerned, we are moving closer to extreme on momentum. You can see right here, we're just about there. Now, again, this doesn't mean that you get a reversal that the market starts selling off as soon as it gets into that extreme range, but because it can get all the way to the far right side of that extreme range. But it does tell you that you're in that extreme. You are in a condition where you could see a pullback or sell off if it were to, if something were to trigger that. Breadth is pretty close as well, and same with sentiment. Sentiment's not as close, but it's kind of still in that high range. The buy-sell ratios are dipping a little bit closer together here, and sentiment is getting real close to that extreme. But nothing indicating that we're in an overbought condition for sure. Nothing signaling that. If we look at the individual charts here real quick, we won't go through the whole list. We do that in the market update classes on Tuesday, but at least look at the major market averages here. Let me switch this over to candlesticks here. And I want to go to the QQQ chart. As you can see, let's put the volume bars on here. You can see we opened lower yesterday. And then when the Fed chairman, or when we had the Fed announcement on interest rates, and then the question answer period with Fed Chairman Powell, we saw the market kind of reverse and start to move up. And so we opened lower but ended up closing positive for the day. That's a bullish reversal, and we did so on heavier volume. We'd had declining volume in the markets over the last week or so, and it could have been because of the fact that everyone was kind of waiting to see what the Fed was going to do. But whenever you have declining volume, when you're rising and on declining volume, that's always kind of a danger sign. But then when we kind of had a bullish reversal day with higher volume, I thought, and you looked at the different sectors, and it was kind of those risk sectors, kind of the small cap tech stocks that have been leading the way. A lot of money was going back into those, and so it looked like we were going to take off again, and then to turn right around and have a down day today kind of surprised me. You don't always expect the market just to fly from here, but I would have liked to have seen it a little bit higher at least. But having it come all the way down today, luckily there's lower volume, and so it doesn't mean that drop is. It does mean that drop is less significant than it would have been if it was on heavier volume. If there's heavier volume, you got to assume this is a correction. Here you have a drop, you have a rally on light volume, and if you had heavier volume on a sell day, it probably means you're heading lower. But it doesn't look like that's going to happen. So it could just be that this is the start of a move higher. One of the things I'm looking at as a possible pattern here is that this is a bullish ABC pattern right here, albeit a much deeper correction than you would want to see because it broke that longer term trend when it dropped all the way down here. You don't love the fact that if this is starting a new trend up, that you're moving up on lighter volume, but this could be the start of move up. This is maybe just a little bit of a correction, and then you might be seeing a move higher from here. So hopefully that's the case. If we start to see more downside, and especially if we start to see heavier volume, then we've got to take into consideration that we might be working our way back down to this low and possibly even lower from there. So kind of a critical spot here. And we'll see if there's any, hopefully there'll be some clarity here. It's not very often I get kind of, I don't want to say confused, but where, I was really expecting the market to be, the NASDAQ to be higher today, and it wasn't. And just kind of with that bullish reversal, I thought for sure it was going to do that. But that's the market. Again, I always say you can't know exactly what the market's going to do. I have to remind myself about that sometimes, because when you've been doing this as long as I have, you start to feel like you know where it's going and what's going to happen next, and you can get pretty confident sometimes that you think you know what's going to happen next. And market does this to everybody. It throws you for a loop sometimes where you're like, I didn't see that coming. All right, so Russell 2000 again is one I'm keeping an eye on. It's not down as much. It's still holding that breakout area, which I think is important. It kind of holds that breakout point. The Dow is up, but that could be viewed as a little bit more of a bearish signal, just because that means that a lot of the Dow stocks tend to be kind of the higher dividend paying stocks, kind of the higher quality companies. They're the largest companies, And so in representing different sectors, that is. And so it's kind of a defensive type play a lot of times when you're seeing the Dow move up and the rest of the indexes move down. But that's what kind of threw me a little bit, because you had kind of the risk on signals yesterday with the NASDAQ really outperforming everything else. Same with the Russell 2000. And then today it's just completely reversed that. So kind of went risk on, risk off. So it's kind of weird. But let's look at the S&P here real quick. Yeah, we want to see that hold that breakout too. It seems to be doing that so far. And again, across the board, the volume has been lighter today. You can see even on a down day for the SPY as well, that you're really, really light volume compared to yesterday. And so that's probably the most positive sign, at least if you're expecting the market to go higher, that it's dropping today on very, very light volume. All right. Let's take a look at some specific stocks. By the way, the trading today, we're going to get into put selling or selling options, being an option seller, and more specifically, selling puts. I'm never going to recommend people sell calls or sell naked calls, is what we would, how we refer to it. We are going to have a class on selling cover calls. And if you're selling cover calls, that's a very safe strategy and one that you want to implement. But selling uncovered calls is one of the riskiest strategies you can get into, and I'll kind of explain why when we get into that segment. But the main focus of today's class, or at least the next couple classes, is going to be on put selling and using selling puts to acquire stocks that you want to own for the longer term. All right, so let's get into some specific stocks here. Under computer and technology, and a few of these we've already kind of gone over, but we always have new people that join in, and if they still look good, I still like to present them. But IZEA, 99 strength rank. Let's switch this back over to signals here. Let me hold on here. Take the volume bars off so we can see the chart a little bit clearer. And this big sharp run up right here, it's kind of a choppy back and forth pullback, and then it's starting to move back up again. Had a nice little bullish reversal candle with the market yesterday, but it's pulled back a little bit today. We're waiting for this to go back to a buy signal anyway for confirmation. So, but it is kind of working its way higher here, at least so far. So that one still looks pretty good, and it has a little ways to go to get to that buy. You're here's kind of the halfway point of the hold. You're on the left side of that, so it probably has a little ways to go before it flips over to that buy signal. And that'd be the confirmation that we're usually looking for in this approach. Another one in that same sector in computer technology is NCTY, 98 strength rank, and anytime I see a stock that's had a kind of an impulsive move, here's the impulsive move up, and then it's kind of moving sideways, especially after it's already had a deeper drop like that, that's usually a pretty bullish price pattern there. You hear me say all the time that, at least those of you that have been listening for a while, but whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways, because that's where it's more likely to go after it's done moving sideways. So you have this impulsive move up. It was moving up, going into this sideways move. Once the sideways move is done, it should continue to move up. Now that, by the way, that kind of setup or thing I look for does not necessarily tell you how far it's going to go or can go. It could just move up a little bit, break out a little bit, and then reverse on you. But in the context of everything, you've already had this big run up, you've had this deeper pullback, and now you're starting to move back up again, and now you're moving sideways right here. Usually that means you're starting a new uptrend, or a lot of times it means you're starting a new uptrend. And so that's a pretty bullish price action there. And there's a few different patterns out there that I really like. You know, a couple months ago, we were seeing all kinds of cup with handle formations and inverse head and shoulder patterns, which are very bullish formations. And when I see those, I'll definitely be pointing those out, and so you can learn about those. Another one in the computer and technology is KOPN right here. There's a 99 strength rank, but kind of a similar pattern here. This looks like let me get more of the chart on here so you can see it. You have this big run up. This looks like it could be a bullish ABC pattern on the pullback. So it's had its larger pullback, it looks like. You have this impulsive move up, and then it's been moving a little bit sideways through here. Now it could move. These things can move sideways for weeks sometimes. So, and again, we're waiting for it to go back to a buy signal for confirmation anyway. But that one looks like it's getting ready to go higher, looking like it wants to go higher. And now there's one I want to go over here in computer technology, and then also in the auto sector. This is a pattern I taught back when I was going through the Elliott Wave training. If any of you have been through that, you remember one of the later, I think it was the last class I taught in Elliott Wave, where I talked about trading wave 3 or wave C. If we go to Blink Charging Company, what stands out with Blink Charging Company is it's had a pretty deep pullback after a pretty nice run, had a nice little run up right here. And it's had a deep pullback where it went to a sell signal. And in that Elliott Wave class, I said, in a bullish trading wave 3 or wave C, you want to see a big downward move followed by a sharp move up, and then kind of an ABC correction or a little bit of a corrective pattern. That was kind of what you're training yourself to look for. Well, that's what we have right here. You have a sharp sell-off right here, and then a sharp move up. So you have impulsive down, impulsive up, which can a lot of times be the type of price action that tells you there could be a bottom right there. Sharply down, then sharply up, and then moving a little bit sideways right through here. So either this is the bottom right here, and this is now starting a new uptrend where this is wave 1, this is wave 2, and then wave 3 tends to be the most bullish or the biggest wave most of the time. So this could be wave 3, wave 4, wave 5, or this could be, here's your downward move right here. This move off the bottom could be wave A. This little corrected move right here could be wave B. And you get a move up into this area, probably right in here for wave C. And then this thing falls apart, has a huge move down. Whether the stock is bullish or ultimately bearish, where it's going to go lower, you have a pretty high probability of this thing going up in the near term. Okay. Now, again, today's price action, though, where it came right back down again. Yesterday looked like that bullish reversal. That could throw this into down a little bit. This pattern doesn't always work. It could be this thing just drops straight from here. But that's the type of formation I'd love to see. And there's a ton of these out there right now. I'm going to show you a bunch that are in the auto sector, or not a bunch. I'll show you a couple. I don't have time to go through a whole bunch, but now, how do I get this? How do I come up with it getting up around here before dropping? You know, if that is a wave C that we'd be trading, how do I come up with this kind of area right here? Well, in the ABC patterns training, I told you that very often when you get your ABC pattern, it'll usually complete at the point where wave C is about the same length is wave A. So if that's wave A, this is wave B, and this is wave C. It'll probably complete about right here, where wave C is about the same look or same length as wave A. They look about the same length. Okay. In fact, if you go back, one of the reasons why I was pretty bullish on KOPN, I think it was KOPN. Let's look at KOPN. Yeah. One of the reasons why I felt like this correction was done was if you look at, if this is wave A, wave B, wave C, that wave C looks about the same length as wave A. So in this case, going back to Blink, if we're talking about a bearish ABC pattern, so here's your drop, and this is the first part of the correction against that drop. There's your wave A. If this is wave B, then wave C should be about the same length as wave A, which puts you up in this area right here. $47 to $48, something like that. Now, what I also do a lot of times when I'm trying to project a move like that is I'll look around and see if there's support resistance in that area. There's a little bit of resistance through here. That's a little bit higher at about 51, but there's also a little bit of support down here a little bit lower. So maybe you don't get much of a move, and it runs into some resistance there and drops if it's ultimately going lower, which I don't know if I don't know at this point which one of those it is. Now, I guess you could say the problem that you might be dealing with, though, is that by the time you get the buy signal, in this case, we're still a ways away from getting that buy signal. It'll already have made that smaller move. I mean, probably by the time this gets up here to where we say it could be wave C, that's probably about where you get the buy signal. Now, the good news is, though, is if it does get the buy signal and start moving beyond that, then you're probably in wave 3. And that means you're probably going to get wave 3, wave 4, wave 5. There's still a lot of upside potential for that trend. So, from a bullish standpoint, you'd get a lot more confirmation that this thing is going higher if this thing goes back to a buy signal. But if you're looking for more aggressive entries into trades, and especially when you start trading, if you're trading wave 3 or wave C, you're usually going to be looking for a more aggressive type entry, which probably would have been yesterday with that bullish reversal candle. But like I said, today, so I don't know that I would have an aggressive entry into this right now. Maybe if it could break out above that little pullback right here, if it could get back above there, it'd be much more likely. But there again, you're shortening up you're looking for just a $3 or $4 or $5 move. You're kind of waiting for that extra confirmation is going to kind of cut into that a little bit. Now, I told you I'd show you a couple in the auto sector. Let's look at those real quick, and then we'll get into the put selling strategy. NEO right here, it's a 98 strength rank. Again, had this big drop. Now, I would tend to be a little bit more bearish on the stock longer term, just because here was the trend right up through here, and it's kind of broken that. If I drew a support line, let me erase that other line. If I drew a support line up through here, it's hard to free draw this. You broke that trend line. You also went to a lower low right here. You got a lower high right here. So you're kind of acting like a downtrend right now. So I would say this is maybe a little bit more likely to be the start of maybe a bigger move down. This might be wave A, wave B. And if you're trading this up into this area right here, $52, somewhere in that area, you're probably just trading a wave C, and then you probably have a bigger drop. Now, what's beneficial of recognizing these patterns and putting in the work to recognize this formation, this pattern, is that, and then you combine that with the options class, learning how to trade options. If I am expecting just a real small move right there, a $3 or $4 or $5 move or something like that, you can really benefit the most from that shorter move a lot of times with using an option, a call option, instead of buying the stock. Get a much bigger percentage return. Again, you got to be pretty confident you're going to get that move, and you got to kind of time it as best you can. All those things I taught in the option class we just got done going over. But this is a great pattern to use with option trades because it has such a high probability you're going to get that expected move. Not always, but there's usually a good chance. And the danger is that there's a lot of stocks showing this pattern right now. So if the market goes lower, it's going to mean there's a lot of stocks that where that pattern didn't work all at once, and that's. But the fact that there's a lot of stocks showing this pattern is what usually that means it's going to work, just because there's so many of them forming it. But just always remember, there's no guaranteed patterns. There's just probabilities, and this is usually a high probability trade situation. But what you could do if this is a wave C is you could do a call option trade. You know about where to get out or where to take profits, because you'd probably want to take profits where wave C is about the same length as wave A. And then if you do get confirmation that it's starting to move lower, and you probably want a little bit decent confirmation of it moving down on higher than average volume, you could buy a put option and then ride a bigger move down. So you can get two trades out of a pattern like that, if you know how to recognize it and manage it. And I wouldn't recommend, if you've never done it before, trying to do that with real money, but that's what virtual trading is all about. You could do some practice trades on something like that. But this is another one where it's possible that maybe this is just a deeper pullback, and this is wave 1, wave 2, and we're going to see another run in the electric vehicle stocks, wave 3, wave 4, wave 5. And then the other one on the list there was Tesla. And Tesla's a really expensive stock, almost $700 stock. And so, and the options are actually kind of a little bit expensive too, but options are a way that you could, an easier way that if you don't have as much money to buy the shares, that you could still trade Tesla with much fewer amount of capital to use. But this is another one where, again, you had the sharp sell-off here, impulsive move up, corrective. This is either wave 1, wave 2, going into wave 3, or A, B, C, or bigger move down. So what would make sense is that wave C would end right about in here. There's a key support level right there in that same spot. Again, that's assuming that this has further to drop. It would also create a little bit of an inverse head and shoulders pattern if it started to move up from here, which would be pretty bullish. So short term, this is looking like you could rally a little bit off of this. But like I said, that's one of the reasons why we went over some of the market conditions before we look at individual stocks, is that when you get thrown a little bit of a curve with today, the way things trading today, you got to factor that in. It could be a possible inverse head and shoulders pattern, but not every inverse head and shoulders pattern ends up being an inverse head and shoulders pattern. This thing could end up all the way down here if that risk off type trading environment kicks back in again. All right, let's get into being an option seller. And let me pull up, and what more specifically, selling puts. Now, the example I'm going to go over is I'm going to go back to that real estate example and review being an option seller. And remember, that real estate example is more related to calls. Okay. And we're going to be as an option seller, be focused on selling puts. But I want to just make sure we understand the kind of obligation that we're taking on as an option seller, because that's what you're doing. You're taking on an obligation. And we're going to be focusing on selling puts to naked puts to acquire stocks. So first understand the concept of selling options, and then focus on selling naked puts. Now, I don't know how far we're going to get in the training today. This is usually meant to be broken over a couple classes, but we'll get as far as we can and then pick up and continue next week on Tuesday. But in that real estate example, if you remember, when I first went over this, you guys were the option seller for that house, right? You were selling me the option, the right. And what I was buying as an option buyer is I was buying the right, but not the obligation to buy that home at that price, that $100,000 price, anytime before that specific expiration date. And we put in a specific expiration date. And I was going to give you $5,000 for that right, for that option. Okay. I was going to pay you that $5,000. And remember, the reason why I wanted to do that is I was expecting the home to go up in value, which means that my option contract would go up in value, and I'd get a much bigger percentage return on that move. That was my. And again, if this is all new to you, you'll probably have to go back in the last couple of weeks and review the training I did on being an option buyer and buying calls and buying puts. But that's kind of reflects a call option. Now, as the option seller, though, you are agreeing to sell that house at that strike price, at that $100,000 strike price. You are taking on an obligation. You do have to perform. If that option buyer at any time before the expiration date says, I want to exercise my option and I want to buy that house at $100,000, I don't care if that house is $170,000 now, you have to sell them that house at $100,000. You have the obligation to do that. Now, you're paid for that obligation. You took in $5,000 to take on that obligation. Okay. If that house dropped in value over that time period, that option buyer is not going to exercise that option. So in that scenario, you would still have the house, you'd still own your house, but you'd be able to keep that $5,000 premium. Now, this is how covered calls work, the strategy of covered calls. We'll go over that next. Okay. But you got to always have to remember that you're taking on that obligation. Now, on a put, if the stock is at $100, and you sell, and let's say we're looking at the Let's look at the 95 put. Let's say that 95 put is going for $2. Now, when you're a call option seller, you're obligating yourself to sell the asset, to sell the stock at the strike price. When you're a put option seller, you're obligating yourself to buy the stock at the strike price. Okay. So in this case, if I sold the 95 strike put, I am obligating myself to buy the stock at $95. Well, the stock right now is at $100. Okay. No one's going to force you to buy the stock at $95 when it's at $100, right? Because if they did, if they said, "Oh, I'm going to force you, I'm going to twist your arm and force you to buy it at $95," you would do that all day long. Great. I mean, buy it at 95. I'd turn around, sell it for 100. I'd make an instant $5 profit, right? So that 95 strike put is out of the money. There's no intrinsic value in it, and it's not going to get exercised. Okay, because no one's going to force you to buy it at 95. Okay, but you brought in this $2. That call option buyer paid you $2, and you don't need to know what their reasons for buying. If they're buying a put, they're expecting the stock to go down. If you're selling a put, you're the option seller. You're believing that stock is going to go up in value. That's a real easy way to remember the focus. Your focus is the option seller's perception is always going to be different from the option buyer's perception. Someone buying a call option is expecting the stock to go up. If you're selling the call option or you're a call option seller, as far as being naked, by being naked, it means that you don't own the asset or you don't have the asset. Okay. Or you're not short the asset, which would be the case in the put option. That's probably more information you need to know there without being too confused. But so just realize that you want the opposite to happen when you're the option seller versus the option buyer. If I buy a put option, I would expect the stock to go down. I'm going to make my money if the stock goes down. If I'm selling the put option, I'm expecting the stock to go up. Okay. So if the stock goes up or if the stock all the stock has to do, it doesn't even have to go up. If all it does is stay above $95, the strike price, by the expiration date, I'm going to be able to just keep that premium. I'm going to get paid that premium. Now, let's say the stock drops a little bit. Let's say the stock drops to $93, let's say $92 by option expiration. Well, now you are going to get what we call put the stock, meaning you're going to be forced to buy the stock. If that option seller is going to exercise his option, and the put is the right as an option seller, you're obligating yourself to buy the stock at that strike price anytime before the expiration date. So because now that option has value, you're in the money now on that option. You would be exercised on it. You'd be forced to buy the stock at $95. Now, this means you got to have money in your account to be able to buy the stock. Okay, and now your broker will be willing to, most cases, lend you money. So you might only have to come up with a third or half of the money, but that's a dangerous game to get into, where you're borrowing money to fulfill that obligation. You would want to make sure you have enough money in your account to where if you were exercised on that option, you could buy those shares. Remember, each contract is for 100 shares, so I would be obligated to buy 100 shares. If I sold one contract, I would have brought in $200 of premium of that's what I would get paid for that, taking on that obligation. But if I was exercised, I'd have to buy 100 shares of that stock at $95 at the strike price, or 9,000. I'd have to have at least 9,500, or I should have at least $9,500 in my account to do that. Okay. Now you say, well, the stock's at 92. I'm going to be forced to buy it at 95. So it's at a higher price than where it is right now. That's true, and that's why there's some rules, the guidelines you need to follow when you're using the strategy. You want to make sure you have reasons to expect that stock is going to go up, and it could be going up eventually. And this is usually a strategy you're going to use on stocks that you want to hold for a while. You're not looking for the short-term fluctuations. So you don't mind that the stock has dropped down to 92, and you're being forced to buy it because you're expecting a much larger run. You're expecting it to go up to $110, $120 or so, whatever, over time. Okay. But even at that, even if you were forced to buy it at 95, you say, well, it's currently at 92. That would be a $3 loss, right? You're down $3, right? Well, not necessarily, because you brought in that $2 of premium when you sold that put, which means technically you're only down $1. And you're expecting that eventually that stock is going to go back up. And if you go back to when you originally sold the put, the stock was at $100. You were agreeing to buy the stock at a cheaper price than where it was when you first sold the put. Now, what if that stock just went up from there? What if it went to 110 or whatever? You get to keep that $200. So this will make a little bit more sense when we go over the guidelines for selling puts. First and foremost, it is a bullish strategy. You need to like the stock and expect that stock is going to go up in value. Okay. Now, your reason for liking the stock could be whatever. But the key is that you expect that stock to go up. Your reasons for liking the stock and expecting it to go up could be that you like the fundamentals of the company. You think the fundamentals are going to grow. And now, I'm not a big fundamental person. I'm the wrong person to ask about trades that have good fundamentals, because I never look at fundamentals. I'm a pure trend, technical analysis trader. And maybe that's just because I'm better with patterns and I'm too dumb to understand fundamentals. I focused on my strengths early on. I could really read patterns, but I'm not a numbers person. So the numbers never made sense. And that's funny, because if you ever talk to a pure fundamental trader, they don't understand charts, and they don't understand how you can have any confidence in charts. And that'll probably be the way it is forever, because fundamental traders never understand technical traders. Technical traders never understand fundamental traders. But your reasons for believing that stock could go up could be fundamental. It could be based on the chart. And I've added in here, so if you've got just what we talked about, let's say you've got a big drop right here, you get a move up and you get a ABC pattern, you think you're going into wave 3. You could be, your belief that stock is going to go up could be that you think you're trading wave 3, or it could be an inverse head and shoulders pattern. And what's nice about those inverse head and shoulders patterns is you can have an idea of how far they can go at a minimum usually, because you can take the distance from the top of the head to the bottom of the head and project that upward. So you could have a technical reason to believe that stock is going to go up. And I've added in there, you could like the story. You could like the fact that a good example is electric vehicles. You could believe that 5 years from now, electric vehicles are going to take over all vehicles out there. I mean, everyone's going to be having electric vehicles. So you're not worried about what Tesla is doing in the near term, or what NIO is doing in the near term. It could be back and forth, but you think that all these stocks are going to be much higher 5 years from now, and you want to acquire as many shares of those stocks right now, and you want to get paid to acquire those shares. And you don't care about the fluctuation. You don't care if they drop down $10 or $15 from where they're at. Although if NIO dropped down $10 or $15, it'd be bankrupt. But or maybe not NIO, but some of those electric vehicle stocks. But you could like the story. It could also be as ridiculous as you think the Reddit traders are going to push a stock up. It could be ridiculous too, but I wouldn't recommend having a ridiculous reason for a stock to go higher. But you want to make sure that if you're going to use this strategy, you have a reason to believe that stock is going to go higher. And I would add in there that you believe it's going to go higher over a little bit longer period of time. I usually wouldn't recommend doing this on trading a real short-term move or something like that. And these are the main rules of selling puts. So it's a bullish strategy. You like the stock, and you like the stock at the strike price. Whatever strike price you're selling, you better like the stock at that strike price, because that is the acquisition price if you are forced to buy the stock, if you are put the stock. So in our example, we were saying the stock was currently at $100. We were selling the 95 strike put, and we're bringing in $2 to sell that put. So under this condition, first of all, I need to expect that stock is going to go up in value. Maybe you have a stock was running up, it came down, an inverse head and shoulders pattern. It was starting to move up, and let's say there's your $100 right. That's your $100 right there. So I better have a reason to believe that the stock is going to go up. I got to like the stock at the $95 strike price. In this case, I know that maybe this does dip down a little bit further before going higher, and so I like it in this range. Maybe I don't like it if it drops below here. I'd like it in this area right here. And so again, what could I do right here with this scenario? I could go out and just buy the stock at $100, right? In fact, every week when we do the stock specific class, we look at these potential trades. We say the confirmation is to get in on the buy signal, and the buy signal comes, you go and buy the stock. Okay, that's one way that you could trade this, or trade that particular stock. Or let's say you decide to sell the 95 strike put. You're saying you want to get paid to buy the stock at a cheaper price than where it is right now. I want to get paid to buy the stock at $95. and I'm going to bring in $2 for that obligation, for taking on that obligation. So we can obviously see the reward. If the stock dips down tonight at or below 95 at expiration, and usually you're not going to be forced to buy the stock until you're right on that expiration date, or you could be exercised early. It could be exercised earlier, and you could be forced to buy it earlier. But most options are, if they're exercised on the expiration date, and they're usually exercised by the market makers, because they're the ones usually ending up with all these options at the end of it. Because most people trade options just to trade the options. They're not looking to exercise the options. But if it's at or below $95 on the expiration date, you're going to be forced to buy it at 95. You get to still keep that $2 premium no matter what happens. And if the stock eventually moves up to $130 or whatever, you get that gain as well. You get to get that gain of the stock. You bought it at 95. It's now worth 130. Now, what's the risk? Well, what if by expiration date the stock's down at $80? You are going to be forced to buy it at $95. Okay. Although by bringing in that $2 premium, your cost basis is basically $93, right? But you're still down $13. Now, if you did your homework right, that could just be an anomaly. You're in this for the longer term. Again, I use that electric vehicle scenario. You don't care where electric vehicle stocks are bouncing back and forth in the near term because you think they're going to be sky high 5 years from now. Then you don't really care. You're going to hold that thing and hope over the next several months it gets up to that $130 price eventually. And if it does, again, you still got to keep that premium, which lowered your cost basis. Your cost basis was basically $93, and it eventually went up in value. So the idea behind this is that you're getting paid to buy stocks that you already want to buy. Now, there's another risk, kind of an opportunity cost risk that you could throw in there. You could say, well, what if the stock goes higher? I want to own this for the longer term. I sold the 95 put, and the expiration the stock is at $102. Yes, I get to keep that $2 premium, but I want to own the stock. Well, then go out another month and sell the 100 put. Bring in another $2 or whatever. It'd be, maybe it's a little bit more than that or less than that or whatever. Bring in some more money. Eventually, the stock's going to dip and pull back, and you're going to end up acquiring the stock. Now, if that's not good enough and you just want to own it right now, then just go buy the stock. But this is a way that you can acquire stocks you already want to own. But again, it's very important you follow these rules. This is always what gets people in trouble, is that they didn't do their homework to know their boundaries, know what, make sure, because what some people do is that stock's at $100 and they'll sell an in the money put, which you could do. I could sell the 110 strike put, and it's going to be at least $10. So let's say it's trading at $12 with the time value on it or whatever. I'm going to bring in $1,200. Think, oh man, that's a lot more than $200. Okay. And guess what? If the stock does go up, then and it goes up, if it goes up above $110 by expiration, you're going to be able to keep that $1,200, and you're not going to have to buy the stock. If the stock only made it up to $105, you're going to have to still buy the stock at 110. That's what you obligated yourself, is to buy it at 110. It's only worth 105 now. But again, if it still feel like it's going higher, you could be a little bit more aggressive. You can sell in the money put, bring in more premium to do that. But remember, this stock could also be down here at $80 by expiration. It could have gone down in value, and now you've got to buy it at 110. And you could really have now you could, that would be offset by the $12 you brought in premium. Okay. Your cost basis would still go down, but, you could get yourself into trouble, especially if that stock's in a full blown downtrend and you were just being greedy trying to bring in premium. You weren't even looking at the chart, or you didn't even bother to look at the fundamentals, or but this is a pretty cool strategy, and you can use it with, in most cases, as long as the stocks that we go over in the updates have options available. You could use them to acquire. You could use a put selling strategy to acquire shares. I would practice it first. And in the next update, I'm going to just kind of show you how you would go about it. I don't have time to do it today, but I'll show you how you go about it, kind of placing the trade. How would you go about placing the trade? But we'll leave it at that for now, the kind of the basics here of put selling. And I definitely would want you to practice it on paper before you do it with real money. And again, you have to really make sure you've got whatever that price is of the stock and however many contracts you're buying. If that's $100, if I'm selling the $95 strike for $2, and boy, yeah, $200 for one contract would be great, but I'd love to get $2,000, so I'm going to sell 10 contracts and bring in $2,000. Well, that means that you'd be obligating yourself to buy 1,000 shares of the stock, or $95,000. You better have $95,000 in your account to be able to acquire those shares if they're put to you, if you're forced to buy. Now, one little twist here. Do I have time for it? I'll do it real quick. Is that money you need to have in your account to acquire the stock does not necessarily have to be cash. Now, you'll have to double check this with your broker, because broker rules might vary or change over time. And if you're listening to this update later on somewhere, or listening to this training later on, there could be different rules in place. But I could have $95,000 worth of Apple stock that I'm expecting to go up in the long term, and I could use that $95,000 in Apple stock as collateral to sell puts on another stock. Now, you have to realize, though, that if you do get exercised and I'm forced to buy this stock because it got put to me, I'd have to sell all my Apple stock to be able to buy the XYZ stock or whatever it is. But if you think that through, you think of what tremendous leverage there is there that you have, that you could have another stock that you own that you're expecting to go up in value, and at the same time use it to bring in other amounts of capital each month. If you were doing it that way, though, you'd probably want to go a little bit further out of the money on the puts, so there's less of a chance that you get exercised. And all you're trying to do is bring in that $200 every month or so. Or now you have weekly options. You could be bringing in premium every week. It'd be smaller amounts of premium though. But anyway, we'll kind of review that a little bit next week, and I'll try to touch on that a little bit more next week to kind of help you kind of see how exciting that can be. All right, thanks, Glenn. See you on Tuesday for the next market update. Bye now.